Well, ladies and gentlemen, boys and girls, it's Jason4 here with your daily dose of reality and news. For any new subscribers out there, if you look down in the description box, every day when I do my 3 videos or so, there's a link that says today's playlist. If you click it, it'll play all 3 of my videos one after the other, so you don't have to go poking around looking for them. One of my favorite banks, if you don't know, and this is, I said that's very sarcastically, J.P. Morgan Chase. Chase Manhattan being the Rockefellers bank, but J.P. Morgan being J.P. Morgan himself back in the early days when he helped cause the crash of 1929 and scooped up all the banks for pennies on the dollar, and then had his buddies at the Federal Reserve print bailout money to bail out his banks that he just acquired for pennies on the dollar. But that's another story for another day. But anyway, Jamie Dimon is the CEO of J.P. Morgan Chase, and he says, according to Zero Hedge, he's warning that something is wrong with the U.S. And then a little while later, after posting that, like as in an hour later, another article, Zero Hedge, we have a serious problem for Jamie Dimon. This is the most troubling chart about the U.S. economy. You know, and I'm seeing this, again, I'm out here doing this daily, at least 3 times a day. Sometimes there's 4 videos because I just feel like, oh, I got to throw this out there. And I've just thought about this today, like today. I said, what are the chances? And this may not be anything, but it did pop into my mind, so I just want to share it with you. Not even sure if I would even believe in it myself, but the fact that it came into my mind, I think I want to just share it with you. All these advertisers boycotting YouTube, you know, Google, YouTube. We're boycotting you because, you know, a fraction of a fraction of a fraction of a fraction of a percent of the advertising we pay. One of those ads came up on a YouTube channel that is about violence and killing, or, you know, gaming violence, or terror things and wars and, you know, hate speech. It's like saying, okay, so 100,000 of your ads played, and 3 of them were on questionable YouTube channels or videos on their channels. And you're really, oh, that's against our brand policy. It's against our brand policy. Interesting. But I wonder if the economic apocalypse is hitting all the big guys, advertisers, and that's why they're pulling back on advertising all of a sudden, because they don't have the funds available like they used to. Because I kept hearing over and over again, 10%, 10%, 10% is all that Google would miss. But the entirety of YouTube creators, video creators, are experiencing up to 90% losses on ad revenue. And that includes everybody. It's not, oh, it's just right-wing only. It's only people that, you know, it's every channel on YouTube, period. So I thought, that's a lot more than 10%. This is an epidemic. Unless those 10% of the big guys, so-called 10%, it's not 10%, it's just huge amounts of money that these people actually had, these companies had, and maybe through subsidiaries or other companies funneled advertising revenue to YouTube or whatever, and it takes a giant pie. It's more like not 10% went away, 90% of the advertisers went away, and we got stuck with 10%. That's what it feels like. But I thought for a second, I wonder if they're just using that as an excuse, and a lot of the advertising pullback, is because their money income sucks, and they got to tighten the belt. But again, for big companies, all companies for that matter, you got to advertise for the most part, especially these big ones. They have to advertise to get their products sold, plain and simple. So I'm not sure what to make of it. I just thought about that. Do I really think that that's what's happening? Maybe it has a little bit to do with it. I can't say. I just can't say, but I wanted to share that thought with you. So speaking of bad economy, Jamie Dimon warns something is wrong with the U.S., according to Zero Hedge. While Jamie Dimon tried to maintain his traditionally optimistic outlook in his annual letter to shareholders, there was a distinct undertone of pessimism in the latest 45-page letter released earlier today, which was actually yesterday, April 4th, which is actually 2 days ago as far as you're concerned, in which he writes that while the U.S. is truly an exceptional country, probably stronger than ever before, he cautions that something is wrong and it's holding us back. Here are the highlights from the gloomy passage reposted below in its entirety. Diamond's letter notes that the economy has been growing much more slowly in the last decade or two than in the 50 years before then, with real median household incomes in 2015 2.5% lower than they were in 1999. And by the way, housing prices, I want to read you something from Simon Black, the guy that does the emails from, what's his thing called? Hang on. Sovereign Man. Speaking of housing, something he just witnessed the other day and got to talk to the head dude at Fannie Mae. I'm going to save that for last. In this video, but I'm saving it for last. So let's think about that. Real median household incomes in 2015 were 2.5% lower than they were in 1999. Now, that's not supposed to happen. Everything's supposed to climb gradually, which is why, I could buy a soda for 5 cents for a nickel back in 1937, And today that soda is, $1 for a freaking can or 75 cents. Not 5. But at the same time, what was a working man's wages back then? Also nothing. Pennies, 10 cents an hour. You know what I mean? Like stuff like that. Which I don't know the exact number, but it's low. Cents per hour. And now, minimum wage, 8, 9, God knows what dollars. $15 over here for this particular area, who are now crushing the fast food industry because they can't afford to pay that. But anyways, point being, they're not making cents an hour these days. It's dollars an hour. So as the years go by, you should always see, household incomes, generally speaking, going up. Even if inflation's there and it's worse or whatever, you should still see the incomes going up. And you're telling me from 2015 to 1999, 16 years later, and it's 2.5% lower? Oh my God. You know what that means? It means everything I've been screaming about all these years is 100% correct. We are in trouble. Economically, financially, everything. We are in trouble. So, and the percentage of middle-class households shrinking, yet not even someone as intelligent as Diamond can bring himself to fully admit that much, if not all of it, has to do with America's relentless debt binge and the gargantuan debt load accumulated and carried by Americans, whether in the form of personal, student, auto debt, be it corporate debt, which is at a record high, or naturally, the sovereign debt, which is on the disturbing side of 100% as a percentage of GDP. And among other things, Diamond has observed that over the last 16 years, U.S. has spent trillions on wars when it could have been investing that money productively. And by the way, I hear the war drums beating on North Korea and now Julian Assange, Mr. Bashir Assad, Syria. Oh, that guy, he used chemical weapons. He used chemical weapons on his people, weapons of mass destruction. Have we effing idiots learned anything? Raise your stupid hand. I'm giving you a hint. Raise your moronic hand. It means you're a moron if you raise it. If you buy that. Flashback, Iraq. WMDs. Dick Cheney pushed that one hard. WMDs, chemical weapons, WMDs. Oh, never had them. And we're using the same line now in Syria. And children got hit by the chemical weapons. Ladies and gentlemen, wake the F up. We see the same playbook played over. This is the equivalent of an NFL team at the freaking playoffs, whatever. And they're doing the same playbook they do every year. They would be crushed because any opposing team with half a brain would know these idiots are using the same playbook. I know exactly what they're going to do next, coach. Let's do it. Let's block them. Oh, we just destroyed them. But when it comes to us, in reality now, no. Assad, I'm sure he used these things on these people and hurt them and kids and we buy that story, we're going to buy it. And Donald Trump, we already drew the line in the sand. We're going to have to do something. And of course, Russia came out immediately. It's nonsense. Don't believe it. And I hope that Donald Trump doesn't believe it, because Martin Armstrong's war cycle and some of the other guys I've showed you, long-term war cycles, it's now. War cycle potential is off the charts as of 2017, according to charts going years and years and years and years and years back. Is it not amazing? We have an enemy every time we need one. When the economy is in the dumps and they can't fudge the numbers anymore, Gerald Celente tells you, what do? They take you to war. And even Jamie Dimon sees an issue. Since 2010, this is him still speaking, another bullet point. Since 2010, when the government took over student lending, direct government lending to students has gone from $200 billion to $900 billion. It has more than quadrupled in a few short years, creating dramatically increased student defaults, population that's rightfully angry about how much money they owe, particularly since it reduces ability to get other credit. Another bullet point, healthcare costs are essentially twice as much per person versus most other developed nations. And final bullet point, labor force participation is too low, he says. Dimon also warns that the regulatory environment is unnecessarily complex, costly, and sometimes confusing. Look at the tax code. Says poor conceived and under-coordinated regulations have damaged the economy, inhibiting growth and jobs. He also says that he isn't looking to throw out entirety of Dodd-Frank Act or other rules. Quote, it is, however, appropriate to open up the rule book in the light of day and rework the rules and regulations that don't work well or are unnecessary. You mean like some that might be tying your bank down, Mr. Dimon? So you can go fruitlessly gamble on Wall Street again and lose the bet and get bailed out again? Furthermore, the JP Morgan CEO sees need for consistent, transparent, simplified, and more risk-based capital standards, and says that it's clear banks have too much capital and more of that capital can be safely used to finance the economy. Finally, in the most amusing twist, Dimon sees too big to fail as essentially solved and adds that taxpayers won't pay if a bank fails, as shareholders and debt holders are at risk for all losses. Just like in the case of Monte Paschi a few months ago, right? We will certainly check back on the hashtag timestamp in several years. So he says, anyways, it is clear that something is wrong, and it's holding us back. Our economy has been growing much more slowly in the last decade or two than in the 50 years before then. From 1948 to 2000, real per capita GDP grew 2.3%. From 2000 to 2016, it grew 1%. And by the way, 2.3% is nothing to brag about. 3.5% is good. It had grown at 2.3% instead of 1% in those 17 years. Our GDP per capita would be, had it grown at 2.3% instead of 1% in those 17 years, our GDP per capita would be 24%, or more than $12,500 per person higher than it is. U.S. productivity growth tells much the same story. Our nation's lower growth has been accompanied by, and maybe one of the reasons why, real median household incomes in 2015 were actually 2.5% lower than they were in 1999. In addition, the percentage of middle-class households has actually shrunk over time. In 1971, 61% of households were considered middle class, but that percentage was only 50% in 2015, down from 61%, right? Many economists believe we are now permanently relegated to slower growth and lower productivity. They say that secular stagnation is the new normal, but I strongly disagree. Labor force participation, too low. If the participation rate for this group went back to just 93%, the current average for other developed nations, approximately 10 million more people would be working in the U.S. Some other highly disturbing facts include 57% of these non-working males are on disability, and fully 71% of today's youth, ages 17 to 24, are ineligible for the military due to lack of a proper education, as in basic reading or writing skills, and or health issues, often obesity or diabetes. He's got quite a lengthy article. I've read enough of that. But the other one he wrote right after that, an hour later, we have a serious problem for Jamie Dimon. This is the most troubling chart about the U.S. economy. And this is about the labor force. As discussed earlier, Jamie Dimon's annual letter to his this year was a departure from his usual optimistic sermons about the state of the nation, dedicating an entire section in the 45-page letter to describe that something is wrong with the U.S. and all of the items mentioned, the following aspect of the U.S. economy is what's most troubling to the J.P. Morgan CEO. Not surprisingly, it deals with two of the biggest threats facing the U.S. currently, demographics and labor, and shows that at least in one key economic metric, the U.S. is now the worst among the entire universe of developed countries. And this is what Jamie Dimon said. Labor force participation in the U.S. has gone from 66% to 63% between 2008 and today. Some of the reasons for this decline are understandable and aren't too worrisome. For example, an aging population. Well, not too worrisome. Actually, Jamie Dimon, it should be worrisome because a lot more people retiring with less people in the workforce to help pay for the benefits and unemployment and disability and everything else and welfare. It strains those who do have a job. But he doesn't seem to think so. So let's continue. But if you examine the data more closely and focus just on labor force participation for one key segment, i.e. men ages 25 to 54, the absolute working age, you'll see that we have a serious problem. The chart below, which I will show you in a second, shows that in America, the participation rate for that cohort has gone from 96% in 1968 to a little over 88% today. This is way below labor force participation in almost every other developed nation, which I don't have to show you that. It shows you it going down to 88%. If the work participation rate for this group went back to just 93%, the current average for the other developed nations, approximately 10 million more people would be working in the United States. Some other highly disturbing facts include 57% of these non-working males are on disability. Again, that's insane. Oh, I hurt my disability. And I'm going to ask you, how many people do you think completely and utterly abuse disability? Well, if I can qualify, I want to get it because I'll get more for, Social Security and Social Security SSI, disability. That's even more money. Now, some people are legitimately disabled, legitimately need it. But how many people fake it because what they get isn't cutting it and they need more? I want to live some kind of semblance of an American dream, so I have to do what I got to do. Got to do what I got to do to survive. Can you blame someone for doing what they got to do to survive? No. But when people fake it, when the rest of us have to work hard, that's just not right. Now, is it? And then we find out we're footing the bill for them. They're faking it, getting paid, and we are footing the bill. It is always, 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 always on the taxpayer's shoulders, isn't it? And they as in the government, will take from wherever that source is. And if you're one of those sources, we're taking from you. So you're either going to be took or you're going to get. They're going to take from you or you're going to get. But if you get, your standard of living is going to come down a lot. But at least you won't have to work maybe at all or a little bit. You can relax and sure, you're not going to have all the fancy gadgets, but you can get your welfare check and disability check and all these other things. Free health care might be totally worth it. And believe it or not, more and more Americans are exactly doing just that. So like I said, I want to end this video with this interesting statement from Mr. Simon Black, sovereignman.com, and hit through his email to me, which is just a newsletter. For the last several days, I've been speaking at an investment conference organized by my friends Robert Helms and Russell Gray. It's been great so far, and my fellow speakers here include the legendary Robert Kiyosaki, G. Edward Griffin, Peter Schiff, and many more. One of the key themes so far in the event is that there are likely problems ahead for the U.S. real estate market. On the first day, I had a great conversation with the chief economist of Fannie Mae, who was also speaking at the conference. And if you're not aware, Fannie Mae is a quasi-government agency that is heavily involved in the U.S. housing sector. You know, Fannie Mae, Freddie Mac. His presentation went deep into the data, showing that U.S. housing is, what he says, late in the cycle, meaning that prices may soon reach their peaks and then suffer a substantial correction. Property prices nationwide across the U.S. have been rising at a much more rapid rate than wages and salaries. This is totally unsustainable. A number of prominent real estate investors and developers have also spoken anecdotally that they're no longer buying. One gentleman who owns and operates more than 10,000 apartment units told us that he can no longer find any properties that meet his investment criteria, as in, I've got to be able to purchase this for a reasonable price so that I can pay it back if he doesn't have the cash up front, return on investment, get the rent in here so I can make a payment and make a living off this and actually earn income for my investors, my company, etc. So what he's suggesting is if I buy this at these current prices, there's no room for me to make money, so I'm not buying anything to rent or anything else. Everything is overpriced and investment returns are falling. Even more amazing, he told us that the banks financed his most recent deals at unbelievable terms. They loaned him hundreds of millions of dollars to fund his real estate projects at just 3% interest and on an interest-only basis. This is crazy, considering that the official rate of inflation in the United States is nearing 3%. The banks practically loaned him the money for free. Think about it. He pays 3% interest, but the money loses nearly 3% of its value each year due to inflation. So essentially the money is zero cost. What an unbelievably stupid loan for the banks to make. As I remarked to the audience, the banks are once again putting their customers' funds at risk and receiving zero return in exchange. This is another sign of a major bubble, similar to what happened 10 years ago in the last crash. Property prices rose far too much, far too quickly, and banks were making completely irresponsible loans with their customers' money. We're now seeing signs that the same things are happening once again. No one here expects that any crash or major correction in U.S. property prices is imminent. But in general, the consensus here is that you're better off being a seller in the U.S. right now rather than a buyer. Right, so no one here expects that a crash or major correction in U.S. property prices is imminent. Oh, really? Well, then again, it's Fannie Mae chief economist. I think it's in his best interest not to say that. But what did he also say? I asked him point blank, what do you think of housing right now, U.S. housing right now? He answered succinctly, it's overpriced. It's overpriced. So when something's overpriced, what happens? And when you have labor participation rates falling off a cliff, less people able to even afford to buy these outrageously priced houses. I was looking today, just poking around, $330,000, $370,000. These houses might be worth $250. $250. Get out of my face. $375. Get out of here. And I can't wait till they crash. And if this foreclosure thing that I was telling you about the other day stays off my record because I disputed it and it's gone now, if it stays off after the auction of the old house, June or so, boy, will Jason M4 be loving life. You mean tell me I can actually go get a loan immediately? Matter of fact, I could probably get one right now. They're going to run my credit report. Oh, there's nothing on there. He's got great credit. Of course I do. It's because I disputed the foreclosure and they wiped it off. But do I want to go do that now? Absolutely not. You don't go and buy into the high. You buy into the low. And that's what my plan is. So just wanted to share that last little tidbit. That's an interesting conversation he had with the chief economist at Fannie Mae, and of course the other guy who does the real estate rental properties or whatever. Just lets me know, Jay Snip, you're on point with what you're talking about, son. You can see it. You're spelling it out for everybody. You're telling everybody every day, this is what's happening. So again, if you have a house right now and you've been thinking about maybe should I sell, should we wait till next year? If I had a house right now, that bastard would be on the market yesterday. Top dollar, give me my money, sit back and wait. Prices crash, go buy another house, maybe two, with the amount of money I got at the high. But that's just me thinking out loud. Take care.